Hello everybody, how are you today? I'm Lisa Pasalacqua. I'm the Relocation Coordinator here for the Defense Supply Center, MWR. And we're doing something a little new to add to our program. We're having a New York Life Insurance 101. But first off, I just want to let you know about our wonderful Fitness Day that's happening Thursday, June 20th. We've got a lot of fitness activities, free golf, fitness, and a bunker after party. So if you check out our website for more details, come on down and see if you'd like to join us. Inside your packet is a wonderful handy-dandy MWR little survey, and if you'd be so kind at the end to please hand them to me on your way out. I've been very lucky to have these two great guys come in and do this for us. Jim Rudolph and Wayne Horowitz with New York Life Insurance Company. I just want to thank them for coming, and I'm just going to turn it over and get started. Let's give them a big round of applause.
Good afternoon, DSCC. We're here today to provide a little bit of education, as Lisa said. Wayne and I work together in New York Life up in the Dublin area, and we talk to people on a regular basis. I was thinking this is a dangerous thing to give an Irishman a microphone. I'm liable to sing you, croon you a tune. But at any rate, what we're going to do this afternoon is not going to take more than the allotted time. Wayne, why don't you give me a first slide there? You can read this. This is the basic format that we're running under. You're familiar with that in the past. And give me the second slide. Today we have an agenda. They always said if you're more than 30 miles from home and you have slides, you're an expert. But you're really an expert if you have an agenda, when you can tell people, here's where we're going, and we'll know when we're there, and then we'll tell you what we told you, and we'll get out. So to begin with, we're going to talk about the whys of life insurance. Why do you own this stuff? Okay? We're going to talk about the types of life insurance. There's a lot of confusion about the different kinds of life insurance. There's two more there, Wayne, I believe.
Yeah, trying to go.
Okay. A little technical difficulty. There it comes. All right. There are things to consider when you're talking about life insurance. Agents, companies, that sort of thing. And then finally, the last one, we hope to have enough time left over for some questions and answers. All right? So, Wayne, you want to pick up this one?
Sure. Good afternoon, everyone, and thank you for coming, as Jim said. Just to go over a few things here. The risk of not owning life insurance, okay? Life insurance is very valuable. Did you know that half the households in the U.S. feel that they need more life insurance? Something always to consider. Following the 9/11 attacks, the Victims' Compensation Fund valued future earnings of potential victims at nearly 16 times income. For somebody making, $100,000 a year, that would be $1.6 million in life insurance. 3 in 5 of the new middle-class retirees can expect to outlive their financial assets if they try to maintain their pre-retirement living standards. Okay, the importance of life insurance. First, you want to build your financial foundation going forward. You want to protect your financial resources. Why do you need life insurance? To provide cash when a wage earner dies? To help pay off debt? To help pay off the mortgage? To help run the household, very important. If someone passes away, you want to be able to keep your family in that house that they've been living in. And you don't want to have to avoid, you want to avoid selling assets to go and pay for those bills. I'm going to hand it over to Jim now to do some of the benefits.
Okay, let's talk about life insurance benefits. These are usually paid to your beneficiary free of income tax. A lot of people don't know that. So when a policy proceeds are paid out, they come to your beneficiary income tax free. The beneficiary may be your family, It might also be your business partners. A lot of people own businesses where they have 2 or 3 people that depend on the other members of the firm, and it's a complementary kind of thing. So when someone dies, the business can survive. Now, where do I begin? First of all, we would think it's important that you work with an agent. An agent, sometimes they get a bum rap, but there's a lot of really good agents out there who know their craft well. First thing that they do is gather information. In other words, like a doctor. They don't just shoot from the hip. They should gather information about you and what your goals are. They should evaluate your family's needs. Some people say they want to make sure that there's plenty of money for college and that kind of thing. And so it's important to evaluate that. We need to estimate what your family would need if you were gone. So if a person's making $50,000 and they pass away, and there's only enough money for $20,000, we've got a problem. There's a shortfall, isn't there? All right, so we want to be aware of that. Then there are expenses at death, such as final illness and funeral expenses. Many people don't know if you died in the first 6 months of the year, your final income tax form even comes, okay? So you have to pay taxes even when you're dead. So that's really important. Then there, of course, are daily ongoing expenses. Bills don't go away. So all of these things added together are important in assessing where you're going. Okay, financial needs. There's your needs, personal. The funds for immediate needs at death, the funeral and final illness expenses, and potential estate taxes. How many people know what estate taxes are? Are you familiar with those? Okay, I see some hands going up. All right, estate taxes, if you have too much money, then the federal government jumps in there and they get a piece of that. So the funds for your needs at death, for funeral and those kind of things are rather obvious. There's a fund for a readjustment period. That's the time immediately following the time that a person dies, where maybe a young family or a family with children moves to a smaller home or to a less expensive area. So there's a lot of money required at that point for readjustment. Funds for ongoing needs, monthly bills, expenses, college, those kind of things that you'd planned on as a couple perhaps before the wage earner passed away. Pretty important stuff. Life insurance can be used to help a lot of different things. The first one is to create an estate. A lot of us don't realize if I want to have an income of $50,000 when I'm ready to retire, if you discount it by 33% for taxes, you need $1,500,000 to produce the $75,000 before tax income that becomes the $50,000 worth of expenses, okay? And so how many people think they're going to be a millionaire by the time they retire? Well, I hope we all are, okay? But if you're not, we need to make some other plans, some ancillary kind of plans. Okay. Life insurance can be used to create an estate to pay off the home mortgage. A lot of people don't realize your wife inherits a debt instead of a paid-off mortgage, okay? If something happens, there should definitely be enough money to cover that. And of course, create a college fund for children and grandchildren. They guesstimate now that the private sector of college education is increasing at the rate of 9%. The public sector is increasing by 7%. So what costs $30,000 today is more likely going to cost closer to $60,000 in 20 years. Okay, so college becomes a major factor. Charitable gifts. I think we've made a lot of people charitable givers, whether they give money to their church, whether they give money to their university, just because they've got enough that they can afford to do it. So these are the kinds of things that people need to look at. Is that something that's important to you? And finally, as we mentioned, if you own a business, might just be a mom and pop business, but the idea might be that if something happens, I want that business to continue on. So there's ways that we can help you with, and life insurance is certainly one of them, to make that happen. So you want to pick this one?
One more.
Okay. The last one on my slide here. It's a way of equalizing inheritances. Suppose I have a business and I have 3 children. 2 of them really don't like the business. They never worked in it and they don't care about it. I'm going to leave the business to my son, but I have 2 other children that I can buy insurance and split that up with them. So I'm treating my children equally. So that's another use of life insurance that's very, very useful. Okay, Wayne?
Thank you. You know, something that we really didn't touch on is that when someone passes away, the bills keep coming. The mortgage keeps coming, the utilities, the rent, credit card bills and all that. And those people are still going to be sending you the bills to your mailbox or to your email expecting payment. The one thing about the insurance guys like us, we're there to bring you a check. Where everyone else is waiting for their money, we're going to be right there on your doorstep with a check for you, for your estate. So that's something very important to keep in mind. How much life insurance does somebody need? Generally, they say the rule of thumb is 7 times. Like I talked about earlier, with 9/11, they said 16 times, which is, albeit a high number, but that's the number that they're using today. But 7 times, I would say, would be the minimum. You want to analyze your specific needs. Some people have children with disabilities or relatives that they're taking care of, perhaps a parent in their home. Future earning potential, you don't know what that's going to be. But by having a certain amount of insurance, that's going to be something that you're going to be comfortable with because you'll have that money to give you that time to get to the potential that you're looking for. We do something called a needs analysis. And we add up the needs. We sit down with you. We talk to you about your family, your kids, your wants, your needs. And, talk about funerals, childcare, mortgages, education, emergency fund. A lot of people don't have emergency funds today. I believe they say that most people are 2 weeks away from having no money at all. All right? You don't want to be there. Subtract assets available at death. All right? Life insurance, Social Security, stocks, bonds, retirement plan assets, business interests, and more. Like I said, we go through a whole financial analysis to see where you are and what you need. And again, we're not there just to say, you need this or you need that. We're there to sit with you and go over and explain to you why you might need it and why you may not. Difference represents how much life insurance is needed under today's circumstances. So it's assets minus liabilities, sort of speaking, like a balance sheet. Life based on earning potential. Projected total earnings up to age 65, assuming a 5% annual increase, including inflation. We figure inflation in there at 5%. And, a lot of people say, well, I'm going to retire at 62, I'm going to retire at 65, and they wind up working until they're 70 or more. If you like it and you're happy, that's fine, but if you don't have to, I don't think you want to. Here's just some statistics. For example, a 25-year-old today making $2,000 a month, all right, their earning potential over their lifetime is $3 million. $4,000 a month, $6 million. $8,000 a month, $12 million. Okay, so as a younger person, you really need to look at that and look and see where those earnings are, and if something was to happen to you and your family was depending on you, where you would go for those earnings. Life choices. Life insurance companies come in many shapes and sizes, which they do. One size does not fit all. Different companies target different people, okay? And that's the thing that you have to look at in those companies. No one kind is the best. There's some that specialize in one type of life insurance, some that specialize in another. 2 major categories that they have is term insurance. Term insurance, for those of you who don't know, that's like renting. You buy term for a specific amount of time, 10 years, 15 years, 20 years, and then at the end, it's gone. You've rented it, and now it's gone. And then there's whole life insurance or permanent insurance, which you have for your entire life, okay, as long as you continue to maintain the premiums. It never goes away. What are my options? Let's go over the term. I'm going to give it over to Jim now for a minute. Go ahead, Jim. Go through the term part.
Okay, term insurance is, as Wayne mentioned, renting insurance. It's the lowest cost premium generally of all insurance initially. But what I tell people is you give up two things with term insurance. You give up your youth and you give up your insurability. If you buy a 20-year term policy and you carry it for 20 years, you're now older and you may be medically uninsurable to renew that. So a 30-year-old man or woman buys a policy. By the time they're 50, they may be into some issues. And so term insurance doesn't fit all situations. It can provide a cost-effective way for a predetermined period of time. It's good for just starting out, for those with a temporary need. The basic death benefit protection, which pays the beneficiary if you should die. And then the type of term insurance is typically based on the number of years it is meant to provide protection. We sell some policies that are 5 and 6 years in duration, some that are 20, some actually go all the way to age 65. So it's really a matter of, as Wayne said, what you determine you need and for how long you need it. All right, term insurance does not build cash value. What's cash value? Cash value is a savings account that occurs inside of an insurance policy. We'll see more about that in a moment. It may be renewable, but the rates will increase over time. Now, permanent insurance, okay, is a little different animal, because what happens here is it provides a lifelong death benefit as long as you pay premiums. Our new policies now go to age 121, believe it or not, because when we run the life expectancy tables and we check probably everybody in here how long they're supposed to live, each one of you could potentially live to be 121 years old. The fastest growing segment of the population is over 101 years old. Okay? It's designed to provide protection for your entire lifetime. Typically, it accumulates something called cash value, and that's a savings account inside of the policy that if you need it for an emergency or you need it when you get ready to retire, you can access that account and have money available for other purposes. So it's like a twofer, if you will. There are several types. Examples, there's whole life and there's universal life, okay? The permanent value, cash value concept is fairly easy to understand, just like term. The cash value accumulates tax deferred. In other words, if you put up $100,000 inside of a policy, there'd be no taxes due on it. When you go to take the money out, because it's contractually bound inside of that policy, it can also be tax-free, okay? If you no longer need as much death benefit protection, cash values can be accessed income tax-free and penalty-free for a variety of life events like college or retirement. So it's a wonderful way to take, if somebody inherits $20,000 from their great Aunt Effie, they can put it into a life insurance policy and come back around and pick it up in 20 years. They will not only have the insurance, they will also have the cash value account. The internal policy values, or the premium offset plan, can be used to pay premiums to continue your protection. In other words, let's say you're 55 years old, you've had a policy for 30 years, it's got a big amount of cash in it. We can then apply those premiums to pay your premiums in the future. So you could stop paying premiums, okay? So that's a very handy thing, if you will. Premium offset is another thing. It's an alternate method of paying premiums due. It's pretty much what I've just described. The company takes the premium out of the policy as they need it. and therefore the policy continues on. And if you cancel or surrender the policy, you can receive the surrender value without any issues. Normally, there's possibly in some of the newer policies that are investment grade policies, there could be some taxes, but it's an excellent way to put money away. All right? Cash value proceeds versus cash value. Okay? Life insurance proceeds is the amount of money, of course, that your beneficiary is going to receive. The death benefit is reduced if you access the policy cash values. In other words, if you use $20,000 out of there because you want to put a new kitchen in, okay, you can do that. But if you do, and then you died the next day, the policy would be reduced by that amount. Then the cash value, the amount of cash available, if you need to borrow some of this from your policy, or you surrendered your policy before your death, these are things that can impact on the cash value and the amount of cash value. So once again, it's a matter of what you're trying to do and the schedule that you have personally. Term insurance, as we said, does not build any cash value by comparison to this. Okay, so that's an important difference. It may be renewable, but the rates will increase at the end of the term. As I'd mentioned, 20-year term, and if you're still insurable, you can renew that term. And if you look at if you have term policies, you look at the term policy in the 20th year, you'll see that the premium jumps dramatically. So that's when a lot of people say, nix, I'm not going to take this policy any longer. All right? So you've had it for 20 years, but now you're only 55 years old and you might live for another 45 or 50 years. So you have to think about that. Okay, life insurance proceeds versus cash value. Well, typically term is generally a tax-free death benefit, as I'd mentioned. It's usually the lowest cost initial option. The basic protection is fixed for a period of time, and it's generally renewable at the end of the term and upgradable to a permanent protection if you choose to do so. But now you were 30, now you're 50, now it's much more expensive to make that conversion. So it would have been something to consider back when you were younger. Okay, permanent insurance. By comparison, generally income tax-free death benefits that I'd mentioned. Coverage never expires as long as the premiums are paid. And a level premium is paid out over the life of the policy. And finally, probably one of the most interesting things is the tax-deferred benefit of the cash value and the fact that you can access it on a tax-free basis. Okay. Now, Wayne's going to pick up on whole life insurance.
Okay.
This is the passing of the baton.
Yeah. Some people have asked me over time, they said, Wayne, term insurance is a lot cheaper than whole life. I just can't afford to pay whole life at this time, and that does happen, and I understand that. And what I usually talk to people about, especially younger families, if you have kids who are going to be going to college down the road, you may want to buy a term policy to take care of that need and have another whole life policy for your permanent insurance going forward. For example, people take out a $500,000 whole life policy, and then they'll go out and they'll take out another $500,000 term policy for 20 years, let's say. What we do is help them estimate, okay, if your kids are 5 and 6 years old, if you have a 20-year policy, by the time they're 25 or 26, they'll be pretty much done with college, and that policy will end at that time, and yet you'll still have the other policy moving forward for yourself and your spouse. So something to think about. Whole life insurance is the most common type of permanent insurance. Premiums are guaranteed, and they're level. The importance of the level policy premium is that you know what you're going to be paying every month as long as you want to keep that policy. We can't, as the insurers, they can't cancel the policy as long as the premiums are paid. and the cash value accumulates. Jim talked a lot about cash value and the policies. It's a very, very good thing. I always tell people they're going out to, some of my clients going out to buy a new car. Instead of you paying the interest to the car dealership, I tell people, take your cash value out of your life insurance, pay yourself back with interest. Okay? It's paying yourself. You're borrowing your own money, paying yourself back with interest, the same as you would do with them. But you're fattening your pockets, not theirs or the bank's. And the cash value is always guaranteed. Always guaranteed. And if you take money out, of course, that portion won't be. And dividends are not guaranteed. But dividends, as far as a lot of companies, they pay dividends every year. Our company has not missed a dividend payment in over 100 years. Universal life insurance, it's a flexible premium payment, and it's subject to certain minimums and maximums. Okay? Universal life can sometimes be a little bit risky, but there are ways to guarantee that on the risky side that you will never lose that policy. There's a flexible death benefit, and that's going to affect how much you're paying every month. Also, you're going to earn interest based on the economic conditions. As we know right now, the economic conditions are not so hot, but going forward in a good economy, it makes a difference. Okay. Policy riders. Everyone know what a rider is on a policy? Different options you could have on that policy. We're not going to go through them all. We'll just hit on some of them. Waiver of premium is very important. Waiver of premium basically is saying that if you have a policy with a particular company and something happens to you and you get injured or you get hurt and you cannot pay that premium, the company will then go after a period of time and pay that premium for you until you're ready to go back to work. If you're permanently disabled and you can't go back to work, I don't know about all companies, but I know that New York Life will pay your premium for the rest of your life. Another one is, okay, I'm just breaking that down. All right. Choosing the right fit. How do I know if a life insurance is appropriate for me? It's a good one. Does it fit your personal goals? Do you understand how the policy works? And again, we sit down and we go through that financial needs analysis and talk to you about it. And again, it's not only our suggestions, but we're also letting you do this. We want your input.
Hi. Good afternoon.
Hey guys, how you doing? Dealer headquarters. Can you hear me?
Hey, Vince, I can hear you. Can you hear me?
I can hear you, Blanche, but I can't see you.
Okay.
Wow. Okay. Ground control to Major Tom? I don't know. Okay, some recommendations. If your agent recommends a term policy, how long can I keep the policy? Again, term insurance, when you buy it, you're renting it for a specific period of time. Can I renew the policy and how? When will my premiums increase? That's very important. All right? If you have a term policy and the premiums are going to increase and you're still going to have kids at home and it's going to be a little tough, it's something that you have to look at. And can I convert this policy to a permanent policy, and if so, what kind? Most companies will allow you to convert their term policies into another type of policy. Okay? That's something that you should discuss right up front with your advisor, with your life insurance person, because if you're going to get a policy and you have a health issue, you may want to convert it right away because you may not be insurable going forward. And is there a time limit on the conversion? Some companies say within the first 5 years, 10 years, 15, all depends on the company. And will I need a medical exam to renew or convert my policy? Depending on when you do it, like I said, if you have a term policy and you run into some health issues and say, I'm not going to be able to get insurance down the road, so I want to convert this to a permanent plan, do I have to take a physical or am I covered? There's a window there, and you have to be aware of that. Some more recommendations. If your agent recommends a permanent policy, are the premiums within my budget? Permanent insurance costs more money, but it does build up cash value. Can I commit to these premiums over a long term? You don't want to have to start putting money into a whole life policy or a permanent plan of insurance, and then all of a sudden, you wake up one morning and say, man, things are tight. What am I going to cut? Okay? If you cut your life insurance and something happens, that's bad. So we always sit down with people and we'll go over with that, the fact that this premium is going to be ongoing for however many years at least. How much will I receive if I surrender the policy? That's the cash value that would come back to you at that time. I'll let Jim talk about the illustration, and we'll go from there. Thank you.
The illustration, wow, okay. This is a roadmap that normally an agent will bring to your office or home and say, here's your policy, and this is what it does over a long period of time. Now, usually these are based on about a 4% return on the money, and depending on the economy and a number of different factors that impact on insurance, it may or may not be accurate. So we, with our tongue in our cheek, will say you can depend on this. However, 99 times out of 100, it's going to be within a certain permissible error, if any. And many times it'll be more. I know our company just increased dividends by a 25 basis points. So that has the impact of driving the cash value up over time. So those kind of things will have an impact. Okay, what does it really show? It shows the premiums, the death benefits, and the cash values. Okay, and as I said, within a reasonable percentage of error, it's very accurate. Guaranteed values and non-guaranteed values. This is the only product that has a guarantee to it. If you went down to the bank and said, I'm going to put some money in the bank, okay, you might come back in 10 years and the bank is not even there, okay? But with an insurance policy, there's actually 2 columns of numbers in that policy shown by this illustration. And one of them is guaranteed cash. It's a little bit less than the other column, but the other column reflects the dividend, okay? So it's kind of interesting that where can you go and invest money today that is guaranteed to be there in the future? And certainly the death benefit does not waver. It's constant, okay? All right. Dividends and interest crediting rates depend on the financial results of the issuing company. Okay, this is where the company is really important. There's something like 1,220 some insurance companies out there, and they're graded just like your school report cards were A, B, C, D. And so if you're going to buy insurance, always check the ratings out. You should try to look for an A++ rated company and one that's got a long track record. They've been around for a long time and what we consider to be over 100 years. So these are people that have survived world wars and recessions and all sorts of things. So you want to make sure you've got somebody that's going to be around. What if I forget to pay my premium? Does the policy provide a grace period? You're on sabbatical or on a safari in Africa. I have a friend that just did this 2 years ago. And the notice comes to your house to pay your insurance bill, and you forget. Okay, what happened to your insurance? The tiger gets a hold of your leg. Okay, basically, it's there's something in your contract called APL, Automatic Premium Loan, that says if you have enough money in your policy, we'll pay the premium for you, okay, if you forget. So that's kind of another thing that's really valuable. Flexible premium policies like Universal may even allow you to miss premiums. In other words, you could pay every fourth or fifth premium and say, I don't have the money this month, I'm not going to pay this one. And you can do that, and the policy values won't be affected that terribly much. Okay, this is one I always like, is choosing a life insurance agent. We talk about a team concept in our business. The team is made up of you, the insurance company, and the agent, okay? But then there's some other players on our team. We refer out to attorneys and to CPAs and anybody else who has a specialty that will be impacting on your situation. So the point is, we get this little cluster of people, and they're all advising you on how we put your finances together and build a complete package from the ground floor, the foundation, up to the next level, up to the next level, and even to the point if you want to invest money, how do you get into investments and that kind of thing. So the first thing you want to do, as I said, we want an A++ rated company. We want to ask for recommendations. Who would they recommend? Okay, what companies are most recommended? Interview the agent. If they give you 3 guys' names, call them up, tell them you want to go for a cup of coffee, and you'd like to just talk to them, see what kind of people they are. Okay, do they know their business? Are they on your side? What you're looking for is somebody that's on your side. Okay. Company affiliations. What other companies are they affiliated with? What banks are they affiliated with? What other institutions are they affiliated with? And that's somewhat important because they may or may not be a stalwart of their community. Okay, so you want somebody that's highly visible. Then, of course, the state of Ohio is pretty adamant about this. They want you to be licensed to do business in the state that you're in. We have to go get a separate license if I want to sell a policy to somebody in Illinois, for instance. Okay? And then professional designations. This is the only business that I've ever seen where they continually challenge you to get designations. Some of the more popular ones are CLU, CHFC, Registered Financial Consultant, CFP. There's a whole bunch of them. And what that really means is these are people that have taken enough time to go to some pretty strenuous classes. And it takes quite a bit of time and money on their part in order to do this and in order to pull it off. And that just simply signifies that they are professional people dedicated to being around and helping people for a long period of time. Okay. The agent meeting, what can you expect? Oh my. Okay. First of all, there should be a willingness and an ability to explain policies and other aspects of insurance-related matters. In other words, a lot of people want to learn first before they get involved with an agent. An agent that takes time to understand your needs is very important. And an agent that will help you determine the appropriate type of insurance and the appropriate amount at an affordable price. These are all things that we've talked about consistently through our whole presentation. But this is where it's really important, is the relationship you have with this agent and his understanding of what your needs are. If you're not comfortable with the service, it's a real good thing to say, this is just not working out, and I think I'd like to find another agent, okay? And many times, if a person did that, you say, well, I know of 2 or 3 guys you can call. So sometimes people just don't mesh, okay? So that's important. We have some benefits with the company that we work for called New York Life. It's an old timer. It's been around 166 years, okay? And it's probably one of the most solid financial institutions ranked by Barron's and AM Best and all of the rating services as being the #1 or #2 company, depending on what the day is. A few last tips. Okay. Don't delay making a decision. You can become inactive from the standpoint of making any decisions by trying to get too much information about too many things. You're never going to understand all the aspects of finances and insurance and those kind of things. But make a decision that can be changed. A person who says, well, I don't know whether I should have what kind of policy I should have, can buy $200,000 worth of term insurance and then work on converting that over time. And if something happens to their health, they're protected because they're guaranteed that they can convert that in most cases. Okay, so that's the way you would make that decision. And don't stand still. It's like being on a ladder. Being on a ladder, you can go up, you can go down, but you can't stand still. Okay? All right. Understand the free look provision. Almost every policy sold in the state of Ohio that I'm aware of has a free look provision. If you decide in the heat of the moment that you're going to buy a policy from a certain person, and all the things come together and all the planets align themselves, and suddenly you're saying, okay, I've got this policy, but I really don't think I can afford it. Well, there's a window. It's called a 10-day free look. And when that agent finally comes by and puts that in your hand, starting at that moment, you have 10 days in most cases. Some have 20 days, but generally it's 10 days. It's the idea that there's a window there that you can turn around and go the other direction and say, I don't want to do this. Okay? So it's a guarantee. So if it takes them 6 weeks or it takes them 6 months, depending on your health and the other aspects of that policy, you always have a window to back out and walk away from it. And then as far as make the check payable to the insurance company, this is pretty obvious. If some guy named Joe Dokes comes along and says, make your check out to me, Mrs. Johnson, then a red flag should go up. The check always needs to be made out to the insurance company. Okay? And then finally, I think, is that the last one? Okay. Okay, where else can I get information? Holy smokes. You can go to any library in the country, and there's at least 2 shelves devoted to financial planning, insurance, and all manner of things, financial. Okay? If you go to any bookstore, there's at least 2 more shelves and a magazine rack with all kinds of books with opinions of other people. So it's really important that right up front you spend a little bit of time researching where you're going to get your information and then check the validity of that information. There's an old saying in this book, if people fail in this business, they go write a book. and many times that's what does happen. All right. So
Want to wrap it up?
Wrap it up, yes. You can see here, and I'm assuming you've got all our slides, so you can look these things up. Well, we've got the library, obviously, your state insurance department, and there's just a number of companies that you can call directly, and they have sales departments that'll work with you. So with that, we're going to break here. We hope we've got enough time to take a few questions from you folks. Did we do a good enough job that there aren't any questions, or do you have some things that you'd like to ask? Yes, ma'am.
Is there something magical about turning 50 and law policies, term policies, and
No, most policies, term policies in particular, are designed to price themselves out of the market at age 70, okay? If they go past 70 at all, the premium is outlandish. And so 50 is not the high water mark, 70 is. But it gets very expensive if you plan to keep that insurance past that time. Anyone else? Yes, sir.
Okay, so you buy a policy and you really don't have money in it until you make monthly payments for a pretty good year before you can take a loan out, right?
Right.
And what are the interest rates on these loans?
Okay, typically the interest rates on most contracts today are 7.4% paid in advance on an annual basis. And people say, well, why am I paying interest on my own money? Okay, well, here's why. The insurance company does not keep your premiums around and just sitting there waiting for you to come back and borrow them out. They take your insurance premiums across the street and they put up a 40-story building So that money is earning interest because that's where they get the money to pay the death benefit if you should die, okay? So in exchange for this, you borrow money and you agree to pay it back at the rate of 7.4%. But in the meantime, the company is still crediting your cash value account with 6%. So the difference is 1.4%. It's cheap money. That's what it amounts to, okay? So it's a wonderful place. When your wife says, I've had it with this kitchen, I want a new kitchen, you could go into your policy and take that money out and do the kitchen and then pay back the money that you took out of your policy.
That 6% is solid or it changes?
No, that's solid. That's written in your policy. Yes, sir. Each policy that comes out has... How many people have life insurance in here? Permanent insurance that they bought themselves on the outside. Okay? Well, Lord love you. I think that's... huh? Well, that's the thing. Like I said, you have to assess how much money am I going to need for my family and for how long. So, okay, I hope we've answered some questions. You have a question, sir?
Yes, one more. So you can design a whole life policy such that after a number of years of making payments, the policy will carry itself, and you don't have to make monthly payments anymore because the returns now are more than the monthly amount.
Yes, sir.
And usually this is like 10 years, 7 years, 20 years.
Usually it's probably after 15 years. And that depends on your age when you take it out. Everything depends on your age and your condition of health at the time that the policy is initiated. But what I want you to walk away from here with, and then I'll sit down, is it's a very fair, legitimate kind of operation for insurance companies to put policies out and for people like yourselves to come along and buy them as part of their permanent plan into the future. And it's one of those things that just, a lot of people will tell these war stories and horrible things that you hear on TV. They only tell the terrible things that don't work, okay? But there's millions and millions and millions of people who buy life insurance policies and use them for the rest of their lives. And the outcome is always good, okay? So we're going to be in the back of the room. If you have any further questions, come on down and we can talk from there, all right? Thank you.
Thank you very much, both of you. Mr. Horowitz, Mr. Rudolph, thank you so much for coming in. On the back, there's a sheet with their names and their numbers if you have any questions. Okay, thank you so much, everybody, and everybody in video stream land. Thank you for watching.